Turkey has a population of 83 million people. It is one of the world's leading producers of textiles, agriculture, motor vehicles, equipment, transportation, and many more. The last couple of years, there have been major economic and social developments in Turkey. There have been increases in income and employment for the past 20 years. But Turkey is now heading into a currency crisis. What has changed? Well, stay tuned. Welcome to the Ecocation channel, where we keep you informed of all major political and economic subjects worldwide. Don't forget to like and subscribe to our channel and press the bell icon to never miss an update. In 2021, the Turkish lira lost half of its value against the US dollar. In February 2021, the Turkish lira had a value of 7 against the US dollar, which dipped to its lowest point in December, where it has a value of 18 against the US dollar. This crash has been partially driven by Erdogan's point of view that lower interest rates will result in economic growth. The devaluation of the Turkish lira caused that many investors switched their savings from Turkish lira into other currencies, for example the US dollar or euro. Despite all the objections from experts and the public, the president continued to push his controversial monetary policy. In October of 2021, the president fired 3 top officials at the country's central bank. Also in March of 2021, he replaced the central bank deputy governor named Agbal after he raised the interest rate in Turkey, which the president vocally opposed. Erdogan's point of view on monetary policy is driven by his interpretation of the Quran's commandment prohibiting paying interest on money. He said on the 19th of December, "They complain we keep decreasing interest rate. Do not expect anything else from me. As a Muslim, I will continue doing what our religion tells us. This is the command." That single sentence spooked the market and caused a 12% drop in the Turkish lira. The president's belief is in contradiction with modern finance theory, and these medieval religious regulations do not mix well with modern finance theory. The first thing we should know is that the Quran strongly prohibits riba, or lending money for profit. This is the reason why the Sharia, Islamic law, considers that money is a simple instrument of exchange and that such cannot be used to make profit. If we take a look at the history of Islamic banking, the founders of Islamic economics agree that the focus of Islam is on human and spiritual development, and the purpose of an economic system is to promote justice and equality. They both believe that the applications of the Islamic law and guiding principles in the economic sphere would bring advances in human welfare and be superior to the Western systems for handling economic affairs, which promote only material welfare. But what changed the systems of the Sharia in the Islamic countries? During the 18th and 19th centuries, the European colonization of the Islamic countries destroyed the functioning social, health, educational, and political structures. The colonization caused that the Middle East and Asia became more trading partners for European companies, which resulted in that Europeans opened banks in these countries. These trading relationships continued to play an important role, and the European financial institutions began to be more prominent outside of Europe. In a later stadium, economic demands increased, and avoiding banks was no longer an option anymore for the local population. As such, slowly the European banks expanded their interest-based model further. Furthermore, as countries became independent, they relied heavily on the new Western system of an interest-based model. Whether the local population liked it or not, they made use of the system. To offer a more palatable choice, some experts proposed an interest-free banking alternative. Nowadays, Islamic banking is growing with a pace of 10 to 15% on an annual basis since the late 1990s. Even some conventional banks offer Islamic financing options. But what is the problem with low interest rates according to the modern Western finance theory? According to the finance theory, interest rates and inflation tend to be inversely correlated. This relationship forms one of the central tenets of contemporary monetary policy. Central banks use this mechanism to manipulate short-term interest rates in order to affect the inflation in the economy. In general, if interest rates are reduced, more people are able to borrow money. This results in that consumers have more money to spend, and this will contribute to the growth of the economy, and this will cause inflation to rise. The opposite holds for rising interest rates. If interest rates are high, that means that consumers will save more because returns on their savings are higher. This results in that consumers have less money to spend, and this will slow down the economy, and eventually inflation will decrease. To better understand how interest rates, inflation, and GDP, gross domestic product, work, you should carefully listen to the next few minutes. Inflation is an increase in price level or the money supply. GDP represents the total economy aggregate output. Annual GDP growth is vital because companies are unable to increase profits or stock value in a declining or flat economy. But too much GDP usually leads to inflation, which erodes stock gains or companies' value. Study shows annual GDP growth about 2.5% causes unemployment rates to fall. But when an economy operates near full employment, aggregate demand for goods and services increases faster than supply, causing prices to rise. Companies must then raise wages, which passes the increase to consumers to higher prices. Explosive GDP growth could cause hyperinflation. The idea here is that people spend more when inflation increases because they know that their money will be less valuable in the future. This causes further GDP growth and price increases. Some insist 0% inflation is ideal, but a little inflation is good. For example, employees want their wages to rise. Now back to what is happening in Turkey. After Erdogan stood firm on his point of view to lower interest rates on the 19th of December, the Turkish lira dropped in value to its lowest point of all time, of 18.36 against the US dollar. He then decided to announce a series of measures to encourage lira-dominated savings in order to ease the pressure on the Turkish currency. The president said in a speech that the government would offer a new financial vehicle in order to alleviate the concerns of citizens who have been buying foreign currency, fearing that the returns of their Turkish lira savings are being eroded. He promised that Turkish lira deposit holders would be compensated for possible losses from the decline of the Turkish lira. He literally said, "From now on, our citizens won't need to switch their deposits from Turkish lira to foreign currency, fearing that the exchange rate will be higher." As a result, the Turkish lira strengthened about 18% against the US dollar, but still the currency has depreciated about 45% in 2021. Since September, the central bank in Turkey has cut interest rates by 5 percentage points, from 19% to 14%. The bank is widely believed to be acting under pressure from the president, who has vocally spoken that he is an enemy of interest rates. Investors worldwide are still not convinced that the words of Erdogan will calm down the market. They still worry for lower interest rates, which will result in higher inflation. Inflation in Turkey reached 21% in November 2021 and accelerated to 36% in December 2021. Economics believe that if this trend continues, Turkey will follow Venezuela and be in a hyperinflation environment. However, Erdogan is convinced that lower interest rates will stimulate the economy, and he said, with the drop of the interest rates, we will experience together in a few months how inflation rates will begin to fall. He pledged to bring inflation down to 4%, as his government has done in the past. But what we see now is that the weakened lira has driven prices higher, making fuel, imports, and everyday goods more expensive for locals. Many people are struggling to buy food and other basic needs. What do you think? Should Turkey follow the modern Western finance theory, where the belief is that lower interest rates will lead to higher inflation, and with this course of action will eventually lead to hyperinflation? Or do you think Erdogan is right? The lower interest rates will stimulate the growth of the economy and eventually, according to Islamic banking, will result in more equality in the world. Let me know in the comments what your point of view is on this. For more interested topics of worldwide politics and economic subject, like, subscribe, and put your notifications on in order to always be updated on what's going on in the world.